Let's bring in John Petrides, Managing Director and Portfolio Manager for Point View Wealth Management. Also, Andy Brenner is here. He's Global Fixed Income Head for NatAlliance Securities. And finally, Kevin Caron. He's the Senior Portfolio Manager at Washington Crossing Advisors. Thank you all on this, well, frankly, a big sell-off today. John, let me begin with you. Your thoughts on what we've seen today. We knew the tariffs were coming. We talked about it, and then they happened today, and the market is selling off and accelerating in that fashion.
Yeah, I think what you're seeing right now is political risk being put back into the market. Look at what's going on. Gold is rallying. Yep. Bonds are flat. Stocks are getting crushed. If this was worried about Fed raising rates, stocks would be selling off and the banks would probably be rallying. Bank of America.
So you don't think the Fed is much of this at all?
It is an issue, but right now this is political risk and worry about the tariffs. Look at Bank of America and Citigroup. They're down 4% right now. Look at Boeing. Boeing is the largest holding in the Dow. It's down 5% right now, which is why the Dow is underperforming all the other indices. So this is a political risk being priced back into the market. That's why gold's rallying as well.
Yeah, I mean, Andy, let me bring you in. Andy Brenner, is this all about the fear of tariffs, a trade war, and what it could do to corporations, their profits, you know, and the economy as a whole?
Well, I think part of it is the retaliatory effects that tariffs would have, but I think we're missing a big thing here. Yep. I think the Fed kind of backed away from 4 rate increases, which a lot of people are expecting, to talking about 3, because I think they see the economy starting to slow down, whether it be retail sales, whether it be the Atlanta Fed, which has been reduced their first quarter from 5.4 to 1.8, whether it be the lack of inflation in wages. I think the Fed is concerned about a slowdown. And I don't know what people are looking, but of course, then again, I look at the market through bonds and through stocks secondarily. Right. But the bond market is rallying today. 10 years, which have been trading between 280 and 90 for 21 straight days, really looks like it's about to take out that 280 range. Yes. And if you do, you're going to have a swoosh moment to 2 5/8. And I think that will probably be in concert with maybe another 700 or 1,000 point downdraft in the Dow. So I think the Fed is starting to get a little concerned. Yes, I still have 3 rate rises for this year, but 4 is definitely off the table, and we might even be talking 2.
That's very interesting. As John said, that bond trade is definitely a safe haven move to see that 10-year level go from 2.9 down to 2.8. Kevin, let me bring you in. What are your thoughts on all of this? How much is this as tariffs? How much is the Fed? Is it a combination of things?
Yeah, I think it's 80% tariffs, 20% the data is softening. If you look at the data globally, you've got some signs of slowdown in manufacturing in China. Business optimism in Europe is starting to slip a little bit. And you have seen a little bit of slower consumer. That's the 20%. But the 80% of it has to do with the reversing of a historic and unprecedented imbalance in trade and capital flows between us and China. Everyone's focused on the trade issue, but always remember the other side of that are capital flows. And those capital flows, as much, if not more so than the Fed, has been responsible for providing a lot of capital, low liquidity, and sponsoring low interest rates here in the United States. So to touch one, which is to touch trade, means to touch the other, and you can't simply do one without touching the other. And I'd add also that if you have interference in deals being done cross-border, that's going to affect direct investment capital flows. So this is a very sticky and unpleasant set of things to have to talk about, way much more unpleasant than the tax cuts of last year. So it's a shift in mentality and short-term pain, longer-term benefits.
Interesting. John, very quickly, is this getting back to normalization? Is this the pain of unwinding what the Fed has been doing for all those years, all that cheap liquidity in the market now tightening? Is this a factor in all of this?
Well, I think you're just seeing a normalization of volatility in the market. There was no volatility in 2017, and now we're seeing it in the market. So you're going to have these ebbs and flows, and I think the underlying economy is solid. Corporate earnings are solid, so sell-offs should be using as buying opportunities if you have a long-term time horizon.